Hello, good afternoon, everyone. Hi, welcome to the SPE Annual Conference. Terrific to see such a full house. Great pleasure to welcome you all to Bloomberg this afternoon. And thanks indeed to Bloomberg for being such generous hosts, not only by giving us the use of this marvellous high-tech venue. I'm still amazed they haven't actually replaced me with AI yet, but also in lending us their head of economics, Stephanie Flanders, who will once again be hosting this afternoon's sessions. And thanks too to the members of the SPE Council who have been invaluable in putting together the event schedule for today. Also to Katie and Sam from the SPE's office for all their work in running and organising this event. The SPE is ending the year actually with quite a bang. Actually, we're hooking up with Chatham House next week for a breakfast event on the US election and what Trump's second term might mean for the world. In a week and a half's time, we have our annual dinner. That's held as usual at the Institute of Directors, and we have Bank of Ireland Governor and ECB Governing Council member Gabriel Makhlouf. He will be our guest speaker. The same week, we've got our AGM, and we round the year off in early December with an event at the Resolution Foundation looking at the challenges of demographic change for global growth. So if you're not signed up to any of those events, or even worse, you are not a member of the Society, then do get in touch with Katie, Sam, or myself, and we'll be able to assist. Or alternatively, go to spe.org.uk/membership or /what's-on. The SPE team is working very hard to provide even more to our members, and whether that be in the shape of either in-person events like this one or online content. But running the Society takes quite a lot of input from a lot of people. And if you would like to help out as a volunteer, whether that be by being an SPE champion for your institution or by helping to provide online content, then do get in touch with us, either any member of council or Laith Al-Abaidi, who is, give me a wave, Laith, wherever you are. There he is. Get in touch with him, who is spearheading this initiative. One other notice, when you're having your coffee at break time, do have a look at the flyers on the poser tables. That's got information on the UK Statistics Authority. The UK Stats Authority and also the Royal Stats Society are very keen to hear from people like yourselves about your data needs. So if you feel well placed to do so, scan the QR code and have a look at that flyer. The meeting's on the 22nd of January, and I believe it's both in person and virtual. But before all of that, we have this afternoon's conference, Revitalising the Global Economy. We'll be hearing from high-profile speakers on various topics, including industrial strategy, fiscal policy, geoeconomics, which is something that Bloomberg is investing heavily in at the moment, and healthcare, with external MPC member Catherine Mann opening the proceedings on monetary policy. Thanks to all our speakers who have given up their time today to share their thoughts, and of course to you all for coming. So without further ado, let me hand the floor, I believe Stephanie is somewhere, I can't see her. Yes, Stephanie, she is our host, chair and compere. Stephanie.
It's great to welcome you back, and I am grateful for Bloomberg for lending me to you for the afternoon. I can take a rest from some of the things happening in Washington, thinking about how we're going to cover them. I guess it's a sign of the times that I not only run the economic research team here, which is expanding into geoeconomics, but also the economics and politics coverage worldwide, which they're teams that are working ever more closely together. And I was kind of struck this morning, John Authers, who many of you probably read, he's one of the most read columnists on Bloomberg. The headline of his column today was, "Inflation needs subtlety now. It's got Trump." And that sort of felt a bit like a sort of byword for economists and certainly for political economy and policy at the moment. You know, this is a time when inflation, the macro situation, demands subtlety. We're marshalling resources for these enormous policy challenges we face, industrial strategy, restoring the quality of public services, confronting climate change. All of those things requires subtlety, keen sense of value for money at a time when The cost of money is probably going to be higher for some time. We've done a lot of research on that as economists. And when, for all that subtlety, the political environment really doesn't seem very subtle globally, things swinging quite dramatically, feels like in one direction at the moment, maybe that will change. Not so much, you could argue, in the recent UK election. But I'm glad that we're sort of with this agenda that George obviously played a big role in pulling together. We've got a lot of those key themes, the subtlety, the challenges, and at the end of the day, some of the geopolitics for you to think about. So on with the show. We have probably, I can't say this because there's probably too many of them in the room who are not her, but I think of Catherine Mann as the most authoritative voice that's joined the MPC for quite a long time, certainly in terms of just not just her resume, but just the degree of respect with which she's held. I think the Bank of England was extraordinarily lucky to get her. She's also a professor of practice at Brandeis. And I wish I would have been taught a bit of economic practice by her at some point. But occasionally when I talk to her, I feel like I get a bit of that. And she's also just incidentally been chief economist of major bank and the OECD. So the great moderation, 20 years on, excellent topic. Catherine, over to you.
It's really always an opportunity for me to come and talk to professional economists. I sort of think of myself as one, card carrying and the whole bit. But it's always good to be part of a network. And the Society for Professional Economists is one of those networks. And I thank very much George for the invitation and Stephanie for that very kind introduction. I am going to talk about the Great Moderation, 20 years on, but also and beyond. I'm of the Star Trek era, so presumably you know what I'm referring to there. So let me begin. In 2004, 20 years ago, the Federal Reserve Board governor at the time, Ben Bernanke, gave a speech titled The Great Moderation. He outlined over the preceding 20 years how macroeconomic volatility had declined substantially and attributed this to three possibilities. First, we could talk about structural change, such as improved institutions, technological advances, and these sorts of things. The second would be better macroeconomic policies, including, for example, monetary policy, but not limited to monetary policy. And the third, of course, is simply good luck, which might include globalization, but also might be fewer shocks. So in his speech, Bernanke concluded that the stability enjoyed from the mid-1980s was not primarily good luck, and that improvements in the conduct of monetary policy played a significant part. Central bankers, pat on the back. Today, I'm revisiting this question with another 20 years of data. And now these 20 years have been defined mostly by continued macroeconomic stability, albeit punctuated by economic and social crises. I will look through a global lens, but also from the perspective of the United Kingdom, which is a small open economy that has experienced not only the global shocks and spillovers, but also some domestic ones. Then I'm going to consider the beyond, meaning the outlook for the future. It's risky to go there, but I'm going to venture to say that over the next few years, at least, volatility in macroeconomic variables likely will be elevated. And actually, we designed the speech prior to the election, so I think I can be sure about this. So why do I expect macroeconomic volatility to be more elevated? A series of global economic challenges lie ahead to which policies will respond, likely in different ways in different jurisdictions. So direct effects of your own policies, as well as spillovers from other countries to the United Kingdom, are inevitable. Higher volatility may come from global challenges, such as climate change, and policies or trends towards global fragmentation. This volatility might have domestic foundations, such as more active use of fiscal policy or through technological adoption and productivity growth. It might come from traditional sources of volatility, geopolitical tensions, and energy markets. You know, given this really long list, it would not be surprising if the element of good luck that was present during the Great Moderation years over the last 40 years might have run out. So what role will monetary policy have to play in this more likely volatile environment? Monetary policy is probably the most important macroeconomic stabilization tool. A macroeconomic environment characterized by stability and low uncertainty supports economic growth because it encourages households and firms to make, not postpone, their consumption and investment decisions. Macroeconomic stability and the belief and trust that central banks will act to achieve it anchors expectations. Now, this supports the effective functioning of monetary policy, its transmission through the economy, and reinforces central bank credibility, a virtual circle. If the Great Moderation had a heavy dose of good luck, though, we might need to reconsider some of the fundamentals of how we believe monetary policy works. If it was mostly good policy, we still can't just rest on our laurels and celebrate success. We must continuously act to confirm the trust. Monetary policymakers need to reinforce public beliefs in their ability to bring about macroeconomic stability by achieving it. My responsibility is to uphold the good policy contributions to continued Great Moderation, most likely in the face of worse luck. So, let's look at some data. In the central banking world, the Great Moderation is often viewed as its greatest achievement, and achieving it is often determined or attributed to the provision of a nominal anchor. So let's talk about what that achieved looking at the data. So this chart plots inflation volatility for the US, the UK, and the euro area. Average volatility, which is in the dotted lines, broken up into two segments, fell from before to during the Great Moderation period. You can see that very clearly in the chart. There is co-movement of inflation volatility between the three regions. That starts to give us a hint about the spillovers. UK volatility is higher than the other two regions, both on average and particularly during peak volatility periods. And I want you to keep that in mind. Second piece of data. This chart shows the annual inflation rate across the jurisdictions. The co-movement is more striking, the deceleration clear, and again, inflation rate spikes are greater for the UK than for the other two jurisdictions. So, bottom line, both inflation volatility and mean inflation fell over the last decades of the 20th and into the 21st century. Across all three jurisdictions, inflation ended up averaging pretty close to 2%, which of course is the anchor. The inflation rate and inflation volatility are related to the key ingredients of inflation expectations, nominal rigidities, and associated inflation persistence. Research confirms that an increase in trend inflation is associated with a more volatile and unstable economy, which also tends to destabilize inflation expectations. Similarly, but on the good side, when inflation is low, shocks tend to dissipate more quickly. To understand whether this period of low macroeconomic volatility will continue, we need to assess the fundamentals of the Great Moderation period. Was it really monetary policy institutionalizing a nominal anchor? Did a more disciplined fiscal regime play a significant role? Is it mostly because until recently, countries hadn't experienced much in the way of energy shocks like that of the 1970s, pre-Great Moderation? What about the role for globalization and technological change? Were individual countries policies mainly the story, or is it more spillovers and global phenomena? So by now I've already set you up for the two potential causes of the Great Moderation, and there's vast research on this that is split into the two schools of thought, good policy or good luck. And as I say, central bankers tend to come down more on the side of good policy. But you always have to question these things before you conclude that. So what about good policy? So part of the story that supports the good policy hypothesis rests on what we think we went wrong in the 1960s and the 1970s. Now, this chart shows that period for the UK, as well as up to the present. And you can see on the left-hand side of the chart, if inflation expectations were on the rise in the late 60s and the 70s, following 2 decades of robust economic growth. Now, you can also see the increases in the policy rate by the central bank did not keep pace. So the resulting real interest rate was too accommodative, which led to the accelerating inflation of the time. Now, this chart shows this period for and this relationship for the UK. In the US as well, researchers show that the pre-Volcker monetary policy rule allowed for self-fulfilling inflation dynamics because nominal rates were raised by less than expected inflation. And the research on the US shows as well that introducing inflation expectations into the policy rule, in other words, explicitly having policymakers incorporate not just the inflation rate, but inflation expectations, and paying attention to both nominal and real interest rates, did stabilize inflation. So back in the 70s, 60s and the 70s, were monetary policymakers asleep at the wheel? We think not really, because the role for inflation expectations, the value of a monetary anchor, and a central bank's commitment were less recognized back then. Additionally, the mismeasurement of important economic concepts, such as the output gap and the degree of monetary restrictiveness, were culprits and perhaps still are. Nevertheless, the good policy argument relies on the idea that shocks propagate differently in an economy where monetary policy both provides a nominal anchor and credibly responds to stabilize the economy following shocks. So a key part of this puzzle, when we think about those elements, is a central bank's institutional framework. So the first two charts that I showed you indicated that inflation and inflation volatility in the 70s and the 80s were considerably higher in the UK than in the US or the Euro area. So what I'm going to do now is give you a short history lesson on the monetary policy framework in the UK. If you want it about the US or the Euro area, please read the whole speech on the website. Bottom line is, it appears that instability in the institution of the central bank, at least, contributed to volatility in economic outcomes in the UK. So how have UK monetary strategies and institutions changed over time? So there are quite a few time periods there and quite a few changes in the institutional framework. But we started with a fixed exchange rate regime under Bretton Woods. That provided the nominal anchor. Then there was no, between 1971 and 1976, there was no obvious nominal anchor in the UK. Now, if you go back to those charts, you will realize that this coincided with a period of extremely high inflation in the UK. Then from 76 to 87, following the success of the Volcker disinflation strategy, the monetary policy in the Bank of England aimed at controlling monetary aggregates. Then another change between 87 and 92, we went back to a nominal anchor through the exchange rate, in particular restricting it underneath the ERM to the Deutschmark. Of course, that did not end well. Following sterling's exit from the ERM in 1992, inflation targeting was formally introduced in the UK under the control of the Chancellor of the Exchequer. And then finally, in 1997, an independent MPC was founded, and it was tasked with achieving price stability defined as 2% inflation, sustainable in the medium term. So with such institutional volatility, specifically with regard to a nominal anchor, it's perhaps not surprising that inflation and output were also volatile. So a few takeaways from the different monetary policy frameworks, and again, go back to the web for the other institutions. The UK was somewhat of an outlier in that the nature of fiscal control of monetary conditions over the 20th century as compared to the two peers. The UK had considerable volatility in the nominal anchor, in some cases not having a nominal anchor at all. And then the third element, which I will return to in a bit, even after noting it already in the historical context, monetary conditions in the UK, the US, and the euro area were and are linked and interdependent. Now, focusing on the nominal anchor and the element that it is played, it's the responsibility, once the nominal anchor is established, it is the responsibility of monetary policymakers to, well, anchor it, anchor the anchor, keep it in place to achieve and maintain macroeconomic stability. Now, we usually talk about the anchor in the form of economics agents' long-term inflation expectations, which should remain a 2% target even in the face of shocks. Now, systematic policy during the more recent Great Moderation years meant these last years were fewer policy surprises. Systematic policy, not so many shocks, fewer policy surprises. That, alongside an emphasis on clear and effective communication of monetary policy decisions. And what does that do? That enables financial markets and the broader public to gauge our reaction functions. To the extent that you understand our reaction functions, that helps keep inflation anchored and enhances our credibility as central banks. Now, the key issue going forward, the beyond, if inflation rates and volatility increase, the potential is for more policy surprises as central banks are challenged to appropriately interpret the environment and react accordingly. So policy surprises come from interpreting a changing environment and reacting accordingly. Okay, so that tells you about a good policy environment. Now let's talk about what we know about good luck. Always have to look at both sides, both parts of the argument. Now, an alternative explanation, either dominant or supportive of the good policy environment, is good luck. You know, what are we talking about when we say good luck? Has it been the case that either the global and or the UK economy have been hit by fewer shocks, smaller shocks, or perhaps a different set of dynamics entirely? So what we're going to look at here is explore the good luck hypothesis by understanding which combination of shocks have driven UK macro variables. What I have here is a historical decomposition of UK CPI into its underlying drivers. This particular output comes from bank staff's structural VAR that features a rich combination of both domestic and global factors in terms of shocks, demand and supply, the differences in monetary policies here and abroad, and the nature of risks. So this particular combination of putting together the package is going to focus on global and domestic shocks. So I've aggregated some of the output into focusing on global and domestic shocks. Now, I've done this in order to highlight the strikingly large role in deviating UK inflation away from trend is dominated by global shocks, which are in pink, relatively more than domestic shocks, which are in the aqua. The trend is in gray. So therefore, the conclusion that comes from this way of decomposing and then aggregating the shocks, is that macro conditions and policy responses abroad should not be underestimated in their role in determining UK prices, and therefore need to be very carefully incorporated into the monetary policy decision-making process. Now, I can also take this same exercise and do a decomposition in a different way. So in this version of the decomposition, not only the source, but the nature of shocks matter. So over the past 2 decades, what kinds of shocks have driven UK CPI inflation? Once I've taken, instead of the global versus domestic look, at a slightly different decomposition. More specifically, to the good policy versus good luck debate, if the high inflation of the 70s and the 80s can be explained by severe oil price shocks, have there been few of those since the 1990s? So this this split, is into this nature of shocks. Are the shocks trade-off inducing or not? Now, this is important because from the standpoint of monetary policymakers, my former colleague Ben Broadbent has pointed out that demand shocks are easier for monetary policymakers to respond to than are supply shocks, because these demand shocks and the monetary policy response do not imply a trade-off between the MPC's primary inflation remit and its secondary remit of supporting growth and employment. And then through the lens of the model, fluctuations in UK inflation has mainly been driven by domestic and foreign demand shocks, that's the aqua. These are not trade-off inducing. So we might say that the job of monetary policy to keep inflation at the 2% target was simply a lot easier during the Great Moderation, up until this very last point, at least up until Brexit, COVID, and Russia. So if the demand story of the last 2 years jars, if you're saying, whoa, you've got a lot of aqua in that last right-hand side inflation shock, if that aqua there jars with your sense of it being a supply-side shock, do remember the size of the fiscal responses to COVID and to the energy price surge. Those contributed to the demand-side shocks. They might have been a totally appropriate response to the supply-side shock, but they were in the end, demand-driven. So this demand-driven narrative for the UK during the Great Moderation years is quite different from the confluence of shocks that we observed over the pre-moderation period. So let's look at those shocks over the pre-moderation period and do a little comparison. So this is making that exercise clear. This decomposition, which is showing the pre-Great Moderation period, now it's not exactly the same model, but it is structured in the same way. The contribution of trend inflation in gray, which was about 2% in those previous charts, in this case, it's very large. It averages about 10% over the whole period. This is way above what we would now consider to be consistent with price stability. So already we know that the 60s and 70s were different. The second thing to note is the contribution of the trade-off inducing supply shocks, these are the ones in orange, to the inflation peaks of the early and late 1970s. So these aggregate supply shocks were much more dominant than the demand shocks, once again shown in aqua here. So this is an evidence in favor of the good luck hypothesis of the Great Moderation years for the UK, because in those years, the orange is small, the aqua is big, so those were easier for monetary policy to handle. On the other hand, there is something that we can look at in this chart as well that sort of supports or hints at the not good policy hypothesis, in that the loose monetary policy, which is shown in purple, significantly contributed to the first peak in inflation around 1975. Of course, the UK did not have a nominal anchor at that time. So I think this is an important way of showing the extent to which monetary policy can either contribute to the inflation dynamics or lean against it. Now I'm going to shift back to, if I can do that. Oh. Yeah. So good luck and good policy, when they come together, contribute to fewer policy surprises. Going back to this notion of policy surprises, the credibility of the central bank and the relationship to anchored expectations. Good luck and good policy, when they come together to contribute to fewer policy surprises, a better recognition of the central bank reaction function, and greater central bank credibility. Now, the econometric models estimated during the low volatility and low inflation period of the Great Moderation, like, say, everything up to the last few years, those economic models reflect the stability as the economy is running closer to long-run equilibrium at full employment and target inflation. So that was, there were perturbations around the trend inflation rate, but they were not all that large up until most recently. So these economic models, estimated over those time periods, when used as part of the policymaking process, these stable models would tend to deliver fewer policy surprises. When good luck runs out, however, it's kind of on the right side, and the economic environment has higher volatility and higher inflation, these models will be less representative of how the economy responds, how it works. Therefore, they will be poorer at guiding policy decisions. Economic relationships that were stable before may be characterized by nonlinear characteristics and changes in monetary policy transmission process. These are topics that bank research has addressed in depth and that I've highlighted in other speeches. The important point is that the dynamics of the responses of households, firms, and financial markets to this more volatile environment will be most salient over the monetary policy horizon, rather than there just being small perturbations around the long-run equilibrium. So under these more volatile circumstances, central bank policymaking is harder to gauge and to communicate, but the commitment to the target is even more critical. So I went through good policy, I went through good luck. Now what about everything else? Something else entirely. So one other big structural change in the world economy happened over the Great Moderation period. It was not so much about monetary policy or the more manageable nature of economic shocks. It has to do with the integration of China into global markets, the expansion of trade, technology-enabled supply chains, and technology-enabled growth around the world, and also long periods of substantial current account imbalances. Now, there's an extensive literature on the disinflationary effects of increased trade over the past couple of decades. But what I'd like to focus on is, from a more macroeconomic perspective, global integration acted as a shock absorber for domestic imbalances, imbalances that would, in the absence of trade and financial integration, be reflected either in domestic price pressures or perhaps costly employment effects. So what this slide shows is that current account imbalances in 5 large economies. In the 2 decades before the 1980s, few countries ran persistent current account deficits or surpluses, in part because of the Bretton Woods disciplines. However, as globalization took hold, the previous slide showed you that, and exchange rates started to float, and importantly, financial markets were deregulated. When this constellation worked together, the world tended to split up into net importers, the US and the UK, kind of down below the zero line, and Germany and Japan, for example, as net exporters. Now, at that time, starting in the early 1980s, current account imbalances switched from being trade-driven to mainly capital flows-driven. So cross-border capital flows were enabled by the financial deregulation on both sides of the Atlantic. Big bang in the UK, you might remember that. So cyclical differences and different monetary fiscal policy mixes were also important in driving these imbalances. Now, as it turns out, I wrote a paper in 1987 looking at these kinds of issues when I was at the Federal Reserve Board. So at business cycle frequency, more trade volatility, and perhaps also more volatility in current account imbalances, may be desirable because buying goods from abroad or selling them abroad means that temporary excess demand or excess supply can be offset with another country. Without trade or financial integration, these demand and supply overhangs would have to be equilibrated in the domestic economy. Now, imbalances this large and this persistence also tells us something about fundamental societal choices and preferences. They have also led to having domestic implications, including being associated with rising domestic inequalities and external vulnerabilities, and of course, have become the source of new geopolitical shocks. So all of this is kind of all backward looking. So we now have to look forward, having a better understanding of what drove the volatility in the pre-Great Moderation period, and then the factors that might have reduced it. So what does it matter if the environment is more volatile? Who cares? It certainly does matter. Volatility matters. I mean, you guys make money off of volatility, so for you, volatility really does matter. At the micro level, uncertainty about the future affects household spending behavior and firms' investment decisions, and of course, financial choices. Uncertainty reduces investment and consumption and employment as it increases the option value of waiting. Now, of course, it also affects the decision to invest now versus later, or save now versus later. So what this would imply, greater volatility on the real side, is that these shifts towards less investment, more saving by deferring consumption, these shifts would tend to lower the risk-free equilibrium rate. This would imply that higher uncertainty means the real R-star falls. However, most people face nominal variables and nominal interest rates. They earn nominal wages and pay nominal prices. So nominal volatility has a particularly pernicious effect on the macroeconomy because of behavioral biases associated with nominal price and wage setting. Now, I've talked before in different speeches about wage and prices being more rigid downwards than upwards, so that inflation does not follow a systematic process, even if shocks are symmetric. So I'm going to try to get myself back to a slide, which I may not be able to do. Nope. Oh, well, too bad on that. Because if we looked at that long trend of inflation since the 1960s, we would see that inflation spikes are always up and almost never down. So that is confirming this ratchet effect that we observe in inflation trends, and then the positive relationship between higher inflation and higher inflation volatility. So if you have higher volatility, you're also going to have higher nominal rates, because central banks will need to be more often leaning against the inflationary episodes in order to stabilize expected inflation at target. Investors are going to demand a risk premium before locking away their cash in nominal contracts, the term premium. So in this view, nominal interest rates, that is nominal R star, is likely to be higher in a more volatile world. So let's go back and quickly recap sources of volatility in the future. We've got climate change, which both climate change itself as well as policies associated with it, and the differences in policies across different environments are likely to contribute to higher inflation volatility. I gave a speech on that topic. Global trade and financial fragmentation. We've already talked about the importance of global trade in terms of lowering prices. Financial fragmentation may contribute to more cross-border issues with regard to volatility. But there is an additional point about reduced global fragmentation and financial deregulation, and that has to do with the extent to which we might be in an environment of lower productivity growth. And lower productivity growth means that any shocks, when they do take place, are more difficult to handle. Let's see, we have traditional sources of inflation volatility, which are geopolitical and energy. We're more likely to have energy shocks up than down because we're already at a fairly low level. So the monetary policy strategic implementations. How might a monetary policymaker best respond to a situation of higher macroeconomic volatility? Perfect stability isn't an option. It's not realistic to even think about it, even though it is often implied by full information rational expectations models. Good policy requires preparing for shocks, being able to observe them, and having an understanding of how to respond. So on the observation part of this exercise, we have in this slide recent staff work to develop a weekly asset price structural VAR to identify structural shocks that explains movements in asset prices, in this case a 3-year inflation swap, in order to provide the policymaker, meaning me, with a higher frequency understanding of drivers of macroeconomic evolution. So what this is showing in the 3-year inflation swap, again, I've divided this up into domestic drivers and global drivers. Understanding that it was global drivers, the pink, that was pushing down on the inflation swap over the second half of the year, while domestic factors, which is the aqua, have been consistently pushing up over the whole year. To me, this gives me a guarded view that the risks of inflation persistence will dissipate sufficiently. Domestic drivers of the inflation swap have been positive throughout the entire year. That means to me that inflation persistence still dominates. So concluding all of this, speak to any policymaker. They'll tell you that policy is never set under uncertainty, and we often say that uncertainty is unusually high, and it's very difficult to address these things. So, we have different approaches to policymaking under uncertainty. The classic reference is Brainerd and Woodford, and they, of course, are they are the ones who argue that gradualism is the preferable approach to monetary policy making, the gradualist approach. However, this gradualist approach requires policy to be forward-looking in terms of economic developments, to avoid being caught by surprise, and economic agents also have to be forward-looking. So with the shocks and the spillovers and the uncertainties that I think are more likely on the upside than the downside, prospects for greater volatility, this forward-lookingness is probably not going to be in the cards. So macroeconomic uncertainty tends to increase financial market uncertainty, which affects the monetary policy transmission process. So what are the implications of this uncertainty and prospects for higher volatility for my decision making? So let's start with this notion, what are the inflation uncertainties? Research by bank staff has importantly informed my view that an activist strategy is the more appropriate strategy for monetary policy. There are different kinds of inflation uncertainties that we could address, but all of them are in the form of, if the shock is actually persistent, but it's misperceived as either transitory or small, the policymaker initially underreacts, inflation overshoots, and then is more persistent, something that perhaps was the case in 2022. So if there is uncertainty about inflation persistence, it's better to move front load and to move in larger increments, which is what, if you go back and look at my votes, what I argued was the appropriate policy stance in 2022. The activist strategy in the future world, well, the terminal radar star is going to be higher, and that has to be considered in the context of restrictiveness. Inflation is biased upward because of the price and wage setting behavior of firms. And that means that activist policymakers have to lean harder against these winds of inflation. But what about right now? Okay, when inflation is decelerating, what is an activist strategy now, to conclude? So in some sense, activists, as I've defined it over the last couple of minutes, is moving a lot, doing big. But it's a bit of a misnomer right now because I just voted to hold. So how could that be activist? What it does is it implies a wait and see to see if inflation persistence has been purged, then to act fast and forcefully. Staff work supports this approach given these underpinnings of the research with regard to inflation expectations and the price-setting prospects of firms. In the current context, the activist approach holds the policy rate firmly until sufficient evidence on diminished inflation persistence is revealed, and then to move forcefully. Thank you.
We just have we have a few minutes for Q&A. And I know that we're going to have some very high level questions in the audience. So I'm not going to take the time. Just on your analysis on the global forces and how important that's always been for the UK, and that certainly sort of fits with observations that one would have made more informally. The broad analysis of either from a market perspective or of economists is that the global environment will be on balance more inflationary as a result of the US election result. Do you share that, and do you think it will come through in particular ways that challenge policymakers in a different way?
So I think that we're looking at an environment that has more volatility, made that argument. That secondly, there is certainly the factors of trade fragmentation, financial market fragmentation, that are upward biased in terms of underlying inflation pressures. It's the job of the central banks to ensure that those underlying pressures do not get manifest in the inflation rate. It's our job. That's our mandate.
But as your chart showed, it doesn't always turn out that way.
Doesn't always turn out that way, but it is our job, it's our mandate, and the issues I think then to consider is what are the consequences of, on the one hand, central banks not achieving that outcome of a 2% sustainable medium term. At least that's our mandate. Federal Reserve has a different one. They have a dual mandate. So what's the implications of, on the one hand, not achieving the 2% target? On the other hand, what is it going to take to get there? And what are the implications of that? So the volatility, the upward pressure is an underpinning of the economic environment going forward. And the question is, how do the policymakers respond?
The other thing, very quickly, because I was one of those who was surprised by the degree of demand side role in the recent inflation, whatever it was, cyan or whatever colour it was, aqua. But it feels a bit, that doesn't go against the intuition that the supply side shocks pose more of a challenge for monetary policy because they inspire that kind of counter-cyclical response from governments. It's because governments are not working in the same direction in trying to reduce inflation. They're actually trying to protect households from its consequences.
Well, that's, there is a balance in terms of who's responsible for what. We take the fiscal policy side as a given, and that is relevant for our decision making. But I think there's a lot to be said for going back to the 70s when there was not a fiscal response that also had consequences as well. So again, yeah, if you take as given a variety of set of shocks that are out there, there's no getting away from having to deal with it, and it's a manner of how the policymaking mix deals with the shocks, and I would say more volatility, and those have different consequences. As I say, back in the Great Moderation period, the shock absorber of current account imbalances was perhaps not well appreciated at the time. It was certainly observed, very large current account imbalances. I got a lot of mileage out of 6% current account deficit in the United States, writing about that. But we need to think about whether or not that shock absorber is not going to be part of the equation going forward.
Questions? Probably got time for a couple. I'll take them at the same time. So, lady at the back. Actually, there's two at the back. Is that Vicky?
Vicky Price. Thank you very much for this. Just wanted to ask, you've given us your reason for and all the analysis for voting against the cut. Were your colleagues looking at different data? And since you're all getting the same information, how come you differ so much to the others?
Well, I can't, we all do look at the data. I think we have different views on the underlying structure of the economy. If you've read the monetary policy report, both in August as well as the one just issued, we talk about three different structures of the economy. One that is more benign, where inflation will recede of its own accord. One that has an economic structure where there is more embedded persistence, and that an output gap is an important ingredient in bringing inflation back down to the 2% target. And then a third structure of the economy, which has more permanent, in the sense of within the forecast horizon, rigidities in the price and wage setting process, and as well in some of the underlying demand and particularly supply side of the economy, that those structures are more rigid, and inflation is more persistent for longer, such that more monetary policy, difficult and tighter monetary policy is needed for longer. So those are three different structures of the way the economy is. Think of them on three different parameters in a model of an economy. So every researcher always spends a lot of time thinking about what structure of the economy is the one that we currently operate in. So I'd say that that's an important ingredient in terms of why we differ in our decisions about appropriate monetary policy stance.
Directly behind her.
James Smith, Resolution Foundation. Thank you for a really interesting talk there. I just wanted to ask how worried you are, Catherine, about another weak recovery from a crisis. So with the economy something like 5-6% below its pre-pandemic trend, how worried are you that we are way off track? And if not, what sort of behavioral supply side story would you tell about such a massive hit to the supply side of the economy? Thank you.
So I do worry. I do worry about the degree to which the UK economy has not returned to its pre-COVID trend. At least one other speech, I've used a chart that really shows in quite stark terms the differences in the UK's economic performance relative to the US and the Euro area. And we can attribute that to a variety of supply side issues in the UK that make it different from the US and the Euro area. Labor force participation being an ingredient, as well as underlying investment being weaker in the UK than in the other two areas. Of course, we can't only look at the supply side in terms of looking at differences in economic performance. We also have to look at the demand side, and some clear differences between the United States and the United Kingdom with regard to the magnitude of fiscal deficit and its associated implications for demand in the economy is clearly an element of that as well. So with regard to policies, there are a range of policies that might be plausible to consider as a monetary policy maker. Most of them are not in my bailiwick. My job is to keep inflation, to get inflation as close to 2% sustainably as possible on the grounds that it is a sustainable low inflation rate that is the best environment in which to support business investment decisions and consumer decisions. Once businesses and consumers start taking up a lot of time and thinking about what inflation is going to be and how to navigate high inflation environment, it means that they are not making the decisions appropriate to either their household decision making or their business investment decision making. So my job is to keep inflation as close to 2% as it can be, and that's how I take that responsibility.
All right, we are going to run up. We're going to take one more because I think okay, just here.
Hi there, Tomasz Wilarek. Just a quick question from me. So you spoke about the stabilizing role of monetary policy in high macroeconomic volatility. But how can you be sure that, especially with an activist approach, monetary policy actually doesn't contribute to macroeconomic volatility or even amplify it?
Well, that's an important question. I mean, we have a variety. I refer to a variety of research, and you can look at the research references in the web version of the speech that is identifying both the assumptions necessary to support the gradualist approach, which yields low volatility and central bank credibility, but only in an environment of small shocks, small perturbations around the long-run equilibrium. And once you are no longer in that regime, then you have to start thinking about a different regime, which is the higher volatility, higher inflation regime, where nominal rigidities become an important ingredient, and that therefore the central bank has to take a more activist approach in order to act forcefully, communicate, cut through the noise that all this volatility is yielding, and be forceful. And that both cuts through the noise of the inflation volatility, but also cuts through the noise of all volatility in the financial markets as well.
Fight shocks with shocks.
Something like that.
Right. Okay. If you promise, it's going to be a very quick one.
Jeff Crocker, you mentioned industrial productivity rather in passing, but wouldn't you accept that industrial productivity is a large part of Ben Bernanke's good luck, and in fact is what ultimately delivers low inflation, whilst itself being hurt by high interest rates?
So there are two parts to your comment. Well, the first part is the importance of productivity for underlying low inflation. Absolutely, I think I perhaps didn't focus on that, but it is certainly the case that higher productivity was an important ingredient in part of the Great Moderation period. I did reference it, look in the speech. But the second point, and I've said it numerous other times, a slow productivity growth in the UK is limiting the speed. You know, it's a speed limit issue, and the terminology we often use, it's a low productivity, low speed limit, makes it much more difficult for monetary policy authorities, much less room to maneuver. The second part of your comment, however, was to infer that high interest rates was deleterious for high productivity. I think that is not true, and for two reasons. The main reason is that high inflation is deleterious to investment and therefore to productivity. So keeping inflation down, even if it means high interest rates, would be the first port of call. But the second point is that when we look at investment functions, the role of the policy rate is zero. The yield curve, long-term rates, a little bit of an effect, but policy rates, no. So there are many other aspects, and in fact, I would worry a lot about high long-term rates because of a term premium, because of high inflation, and that is a more deleterious effect on investment than is changes in the policy rate.
So there. Okay, You've got us off to a terrific start, Catherine. Thank you. Yeah, I think it's gonna be put us on a very high level. So thank you.
Thank you very
Catherine.
much.
So now we're having a fireside chat conversation about industrial strategy and some other topics with Ray Newton-Smith, currently the Chief Executive of the CBI, had spent some time at Barclays before that, but then previously was very well known as the Chief Economist of CBI. So, Ray. So, yeah, we had talked about I think there's a few things we want to talk about. We want to talk about industrial strategy. What does it look like? What do you think of the sort of new government's initial consultations on this? I think we obviously have to think about the budget and some of the response to that, and maybe touch on the US election at the end. Invest 2035. The UK's modern industrial strategy, that's the strategy that was released a few weeks ago by the government, and I guess we're going to get the final version alongside the spending review next year. What do you think? What are you looking for out of it?
Well, so many things and so many topics to cover, and I'm sure we'll come back to the budget as well. But first, I wanted to acknowledge as a chief economist, it's a former chief economist, great honour to be here at the Society of Professional Economists, and I'm now as a chief exec understanding what a superpower being an economist is, because as chief economist I had to address lots of sort of chief executives and sometimes didn't understand why. When you asked, did a presentation, there would sometimes be sort of silence in the room, and I'm now realising it's totally intimidating being in an audience of economists. But also just want to acknowledge what an amazing role the SPE does. If you're not a member, you should be. It's just really important to support professional economists in everything that we do. And who knows, being an economist can take your career in paths that are sometimes unexpected, but I think super, super important. So the government's industrial strategy, well, I suppose it comes down to, I think one of the challenges the government is facing is it does feel like a lot of pressure is being put on the industrial strategy as a strategy, and it's sort of being put there as the answer to everything. And it won't be able to answer all of the things we need to deliver in this country. But I think from the business leaders I speak to, and also bringing an economist lens to it, what do we want to see? Well, I think it must be in a strategy, and it's got to start strategically and think internationally. So I think we do need to think about where the UK's comparative advantages are. So we need to think about, the role of trade in services particularly. I think if you look at some of the really successful industrial strategies globally, and I think for us, we need to not focus narrowly on a very narrow definition of industry, but really think about a strategy for our economy. They have generally tended to start from where is the world going? What will the world need in 5, 10, 20 years' time? What are we as a country particularly good at? And try to focus on those. But then the other area is really thinking about the horizontal enablers, the things that really enable growth across the economy. So, we can probably come back to some of the things I think where the UK has real capability. But I think one of the things the industrial strategy will have to think about is, what's our strategy around aviation and transportation, because that's so important about not only how our goods and services can be delivered globally, but how, people are able to get to their businesses to be productive. So it really is needs to think about that. It needs to think about our approach to skills and immigration. And and also mobility. So a lot of trade and services isn't only about how people move between borders to, for full, long-term employment. It's about how people move across borders to deliver architectural design and provide creative services. So, and then it also, I think that a very economist encapsulation of people, capital, and ideas is a very good framework to start with. So thinking about, not just immigration, but also skills and how we invest in that. But more broadly, that innovation ecosystem. And I think you can see, and this is where I think the government have started to set out some really important thinking is about setting budgets for the long term. So making sure we have a research and development budget from government that's set not just for the next 5 years, but over the next 10 years. And I know that's something Patrick Vallance is really keen to ensure we see. So it is partly about making sure we have those set out for the long term. And then, and then it is thinking about where are certain sectors where we might have a comparative advantage, where there's, and not really, I think you have to be you mustn't overplay the sectoral lens on it. It's about what are the sort of, that mission approach, where are the technologies and change that's happening in our society where the UK can lead the world. And I think, a net zero transition is one. That's something that's happening to the globe. How we tackle climate change, the technology, that is a huge economic transformation. So how are we playing our parts in that, but also then thinking strategically, where are the capabilities that the world needs where the UK is particularly good?
We had a question from the Resolution Foundation. I did see a little bit of influence of some of the work that the Resolution Foundation has done on UK comparative advantage and the way they thought about the sectors. And we have to add the eight growth driving sectors to the 5 missions, and I can't remember, there were the steps as well. Anyway, we've got a long list. But there's a sectoral piece, and as you say, whether you've picked the right sectors, or at least are thinking about the right linchpin sectors. One of the things from sort of the ghost of industrial strategies past, I think it was, three prime ministers ago or something, I'm trying to remember, that was the regional industrial strategy, which a lot of cities and local areas actually spent a lot of time on. I was partly involved in the Manchester one, and then which was just sort of ditched unceremoniously one day in autumn a few years ago. Do you think there's enough here on the regional, the place-based analysis, which we tend to think also has to play a big role?
Yeah, and I think the art of doing an industrial strategy really well is starting from that global picture of what's happening in the world, which we know has moving parts at the moment, but then also thinking what's happening locally and regionally, because investment ultimately happens in a place-based scenario. I mean, I do think moving away from some of the language of levelling up is helpful, because I think, the idea that one, it's not very aspirational, because it's a sort of, we all just want to sort of level off. And I think we do want something that's visionary, but also, importantly, it isn't that if one, it has, from my mind, has this sort of zero-sum aspect that if one region gains, then another loses. And I think what we know, even within the UK, which is geographically small, London's ecosystem and supply chain reaches throughout the UK. So I think that's been a helpful development. We actually brought together the majority, over 10 of the metro mayors last week in Birmingham to just talk through their local growth plans and what...
Which grew out of a lot of these things.
Exactly. Yeah. And I think one of the things that's important is remembering the history. So I hope that those plans are being sort of dusted off. And we have to remember, one of the problems is industrial strategy has never really stuck. So, let's try and get it right this time and make sure things stick for the long term. But it is about how we work. I think we're getting better at doing devolution well in the UK, but it does need to move faster. And I think where the mayoral system really works is you have local leaders who can be champions for their region and their sector, both in the UK, but also internationally, and that really matters. And I think they can also get a sense of what are the skills gap within their region. And if you take something like, so, people, capital, ideas, and then some of the enablers around transport, in some areas you're going to, like in Newcastle in the Northeast, you need to think about, your aviation strategy in particular. And in some areas it's more going to be, particularly in the Southwest, right? You need to have a logistics and you need to think about road travel because we don't have, the rail system isn't connected enough. But obviously, as we know, one of the challenges in the rail system, not to open old wounds, but obviously, HS2 and then how you open up East-West rail in the UK is really important for connecting our major cities in the north of the UK.
Just one more on industrial policy, because I think it's kind of fundamental, and in some ways, economists haven't always focused on this in all the talk about Bidenomics and the sort of move to tariffs and the changing approach of the US. Is certainly as described by Jake Sullivan, which I think was a kind of providing the intellectual underpinnings for a lot of what we will continue to see we saw on the first Donald Trump, and we will continue to see a Donald Trump too, was this idea that being a winner and a loser has been changed by the US, China, but by the way the world is moving geopolitically. And that there are key strategic products and sectors where it's not just a question of whether you end up making money back on your investments, the backing winners versus backing losers. It's whether you have access to solar panels in 40 years' time when China decides not to sell them to you anymore. And I think that's something that's quite hard for an economist who's been sort of taught about how to think about industrial policy and how, and sunk costs and all those things, completely changes if what you're trying to avoid is a sort of zero-sum outcome where you just have no access to that entire product that you really need for your supply chain. So I just wonder, is there these kind of industrial strategy, how much, I know that they've thought about it a lot, many people in Number 10 and across Whitehall, but how easy is it to incorporate that in this kind of strategy, the idea that there is something, we actually do have to think about supply chains and the resilience and the vulnerability of supply chains, even if we're not going to be very profitable in it,
Yeah, I think there's a couple elements to it. It is, I think we've all become more aware around that broader issue around economic resilience, whether that's thinking about how do we make sure our economy is resilient to a future pandemic. There will be, future health things that happen in the world that we need to have capability and thinking about energy.
War breaks out in Western Europe.
Exactly, and energy security as well as, energy efficiency. So I think it is more, and of course the other thing, which is more, is also thinking about cybersecurity and, and as much as in a world of connected devices, but this cybersecurity becomes even more important, and it's quite alarming when you look at and actually I joined voice with the head of MI5 talking about actually businesses probably aren't as prepared for attacks as they should be, and what do we do from a public policy point of view, but what can businesses themselves do, and just at least being aware of the risks, I think, is a first start. So it is more complicated. I think what we can't do is so, I'm often asked the question of, well, China is the world's biggest manufacturer of solar panels. Surely in the energy transition, shouldn't we be producing the solar panels ourselves? And I think when you see how different technologies are developed, I can't imagine a world in which that is going to make sense in terms of our broader comparative advantage. And actually, some of the studies have shown that even in World War II, actually, when specific materials are, you can't find, the economies do adapt. And that is, so there are, if you're suddenly cut off from a particular product, there are ways around it if you're given a bit of time. And so I think we need to think about what are some of the material, and it's almost going below what you need. It's what are the commodities and materials that you will need, and thinking about that, and almost having a plan for some of those scenarios, but also not trying to, we're never going to be the world's manufacturer of solar panels, and nor should we try to be.
And obviously the risk is it justifies an enormous amount of
Subsidies,
unproductive investment. Yeah. That's the nightmare. And diversity of supply, as you suggest, can get you there. Okay, the budget.
The budget. Well,
there has been, as it says here, UK businesses have now had a couple of weeks to digest the budget. There's been a bit of indigestion.
Yes, I think the word we've used is I think there's quite a lot of disquiet amongst the business community. So probably helpful if I sort of walk through it. So I think that, and it won't surprise you, I'll start with where I think there were some really important step forward with the budget, and then I will come on to quite directly where the challenge lies. So I think the extra space within public finances to really prioritise capital investment, in particular public sector investment as a share of GDP, particularly in this audience. We look over the medium term, we know, and over the longer term in the UK, public sector investment as a share of GDP has been too low and too volatile. So, and we know that in the forecast horizon, that was due to fall back as a share of GDP. And yet, if you look at
40-year low.
Exactly, all of those things. So I think creating more space to prioritize that, and again, for the long term, really important. And if you think about it gives more space for investment in the energy transition, in the capital infrastructure that we know this country needs. And I think that was important, and will, I think, have, over the medium to long term, have an important impact on growth in the UK. I think also setting out the corporation tax roadmap, being clear that that they prioritise full expensing to encourage business investment, R&D, tax credits. Now, all of those were things that were in place before, but sort of saying, look, we are going to commit to that over this Parliament and follow through, I think, is important. But the real challenge is that, the test I think business leaders were saying is they wanted to hold the government to account. If growth is the mission and the solution is investment, we know the vast majority of that investment has to come from the private sector. If you then look at what was set out in the budget, there wasn't really anything to drive business investment over the next 3 to 5 years. And actually, as we know, in part because of the rise in national insurance contributions, actually what you see is business investment growth as a result of the decisions taken in the budget were weaker according to the OBR.
Although, as they admit, there's a lot of uncertainty.
Of course, there's a huge range.
They're assuming that it
there's a huge range of uncertainty. But I think what I would say, and from from the CFOs that I speak to across larger businesses, and I think we have to remember that when you look at business investment, for every £1 an SME invests in the UK, a larger business invests £500. So if you want to drive business investment in the UK, you have to have the confidence of the larger businesses to say, I'm going to invest here in the UK. And the challenge with the national insurance contributions, and particularly the dip down in the threshold, is that as a CFO, you and your board will have set out your budget for next year, and you will have apportioned, this is what I'm able to do around pay. Many of the businesses have said, we've already agreed our pay settlements. We have our budget for capital expenditure. Our pricing is already determined for next year. And if you're then having to face an increase in national insurance thresholds or in overall costs, then that has to come, it comes out before you've made a profit. So you then have to look at what can I do it reduces my headroom for investment, or it makes it harder for me to hire more people, or I may even need to retrench, or I need to look at my pay settlement. So in the short term, that money has to come from somewhere, and that's where you can see in the OBR projections, they do have that lower business profitability and lower business investment in the near term. So that is where, and I think the challenge for businesses is they couldn't then sort of point to, but they in the media, they've done X, Y, and Z to really, boost business investment in the short term. So I think that is where, the disquiet is, and it then puts more emphasis on let's get the industrial strategy right. Let's think about how we make, the skills and a apprenticeship levy more flexible to really deliver the training we know we need to drive our productivity. Let's really think about, and of course, there are particular sectors and types of businesses that are more impacted by those changes, particularly those who employ people on part-time or lower wages. And probably, we haven't really done the gender analysis, it could be that more women are captured within that. So, what can we do around business rates reform, around some of the other areas that will really make it easier for those businesses to invest and to be able to provide more jobs and opportunities?
I guess you could say, one response, not quite a defence, but a response would be that this was the budget represented a set of things which together was a necessary macroeconomic adjustment, public services and other things, filling the hole, some of which might have positive micro consequences, but it will depend on other policies, and even the sort of impact on overall growth and private investment could be helped by sort of decisive planning reform, fantastic industrial policy, things that will change the microeconomic environment, even as you've had to do this difficult macro thing. So I just wonder, do you get the sense from talking to government that they are serious about that? I mean, they've obviously talked about it a lot, but do you think they know what's involved? Do you think that they are moving at pace to really change the environment for things like planning, or are you still waiting to see that?
I think if you look particularly in the first 6 months of this parliament, I think the pace of delivery was really impressive. And I think on planning and on really understanding that one of the things that holds back, big capital investment in the UK is getting planning permission, is getting a grid connection. And so the more that we can invest in our grid capacity, those are things that have been holding back investment. And I do think this government is committed to tackling that. And actually, if you look at the pace of delivery from the Department for Net Zero and DESNZ, it is impressive. It's a great name. Just in terms of what has been, some of it quietly, some of it more, it has been well publicised, I think have sort of got on and really been focused on delivery. The challenges we know, though, and I think even just approving planning on data centres, some of the housing developments, just being bold enough to make some of those decisions has been important. But it's going to get more challenging when some of those decisions get more and more political. And so I think it's too early to know how, but a government with a large majority should be able to see the course on that when it gets, when some of those decisions, I guess, butt up against local opposition, which is bound to happen. And I think, though, one of the things that we probably also need to see alongside the industrial strategy is really thinking, the government's committed to think more strategically around energy nationally and spatially as well. We need a spatial plan for energy. But we also almost need, and we're not such a big, that land management strategy, what is the overall allocation for solar farms versus food production? We know we need to do a lot around nature restoration. We're one of the most depleted countries in terms of nature, but really thinking about some of those competing priorities on our land strategically is something that no government has really been able to grapple with, but we do need to do it, because at the moment, I am sure some economists should do this. If we sort of totted up all the things we've said in terms of what land we need for nature restoration, for agriculture, for housing, for the built environment, a bit, you know, and data centers, we'd suddenly realize we'd already used up all our land that we have already. So,
Overdetermined.
you know, exactly.
There'll be a lot of people. I want to have we have the next speakers waiting, but we've still got a few minutes, and I think there'll be some questions. I guess a more basic question coming out of the budget, especially, and a lot of your members will have looked at the headlines the next day, that basically said, you know, they talk a good game, they claim they're sort of into growth and pro-business, but when it comes down to it, this is an old Labour budget, and they have old Labour instincts when it comes to things like private school fees and other things, you know, punishing aspiration and, you know, piling taxes on business in order to put money into public services. Without commenting directly on the headlines, I just, you know, what is your response when members say, don't we just have to hunker down for an old Labour government and everything else is just guff?
Well, I suppose we would sort of say, you know, again, and it comes back to almost where I started around that sort of the economic superpower. I think where we can sort of help and say and our role is always to be a critical friend to government, whoever they are, and to work with all parties. But I think we can look at some of the decisions that the government have taken that really do help to deliver that long-term economic growth that the UK needs. And also part of our role is almost to communicate what the strategy of the government of the day is, but also then to sort of hold a light up when the execution doesn't necessarily match with strategy. And that's where I think in the, you know, as we've sort of said to politicians, there's a real challenge about how you drive business investment over the next 3 to 5 years. And the problem is if we take the budget in isolation, there isn't anything there that really shows how we can deliver on that. So what can we do in some of the other broader policies to make sure that we want those forecasts for business investment to be seen in hindsight to be too pessimistic, right? That's whatever, you know, ideally we want to see business investment growth to be stronger than the OBR is set out. But that's going to take, I think, a lot of work from the broader policy environment. And also the challenge we have is the rest of the world doesn't stand still. So we need to think about what's happening with US tax policy relative to UK tax policy. These things will come into play and matter.
And relative to a year ago, if sort of it was one a year ago in terms of your ease of access and communication channels with the government, how is it now?
So I think from look, you know, I've had the privilege of working closely with a range of chancellors, and we worked really closely with the previous chancellor, and we're working really closely with Rachel. I think one of the things I think our role is almost that institution and capacity building. Particularly, we've got to remember there's a whole bunch of new MPs who maybe aren't as familiar with the business community and also just institutions and the economy. So I think we play a role in that as well. And I think more broadly, it's, I suppose, shining a light on the broader economic policy. What is it delivering for business, and being prepared to be honest when some policies are working and when they're not.
Okay, time for maybe a couple of questions. All right, these two, and then we have. Oh, okay. Why don't we take this? Yeah, these three, and then that'll be it there.
Hi, Richard Woolhouse from Abbott Laboratories. What are your multinational CEO members telling you that the UK needs to do to become a more attractive place for multinational investment in the context post-Brexit and post-Trump too?
Well, I mean, so many. I guess it does start from that. I mean, a few things. I think and it is as a new government comes in, one of the things our members have been clear is like use this moment to really set out the pitch for why invest in the UK. So some of that I think has been about resetting our relationship with Europe and sort of leaning into some of our international leadership. I think those things do matter. There's still a lot of work to be done. And it's certainly not going to be an easy ride more broadly. But I do think it is about looking at our overall, where is our rate of corporation tax? What is our incentive around R&D innovation in the UK, and making sure that that's competitive from a global sphere. And then, a lot of what people sort of say is removing some of those blockers to investment, whether it's planning, whether it's getting a grid connection, because sometimes global businesses will want to be investing in the UK, but they can't if they're at the back of the queue relative to someone's domestic grid connection, then that's not a strategic choice. So but I think fundamentally people say is you've got to remember when you are, and this we saw some of this challenge, and we had quite open conversations where if there may be things that you feel might resonate with the domestic audience, but when you are speaking as a chancellor, a minister, or anything, your words are heard around the world globally. So part of the role is to really talk up the UK's capability and make it easy for global boardrooms to say, yes, I believe in the UK and I'm going to invest. But fundamentally also what you need to see is stability and just a sense that you have a government that's committed to a strategy that will last, ideally beyond the next parliament, and that you have that consensus as well, but between parties on the direction the country needs to go.
Still working on that, I think. But okay. Yeah. So you had your hand up before, yeah? Yeah.
Douglas McNeill, former UK government economist. Rain, part of any strategy, an important part, is what one decides not to do.
Yes.
Are there any activities that you think the UK should be doing less of? And if so, what's the best way for policymakers to explain to certain sectors, certain areas, certain workers that they're not part of the plan?
Wow, great question, and nice to see you. I think, one of the things, and the harder things to, almost to articulate, actually, I thought the question we were going to ask is sometimes the decision to not do something or not, often, and again, I'd sort of come back to, I think setting out a tax strategy for the part of the reason why you do that is to sort of say, I might have done this, but I've decided not to, and I now have a way that you can hold me to account that I won't change my decision on that. I think in terms of sectors, I think one of the things that it's important, and this is where, trying to, is not just always going to, a sector of business that might, shout loudest or have a particularly charismatic leader. You need to make sure that you have that evidence-based approach, and that's partly about, the voices you listen to. But I think more fundamentally that challenge is if you are, take the energy transition, we know that over time we will see less jobs traditionally in extraction in the North Sea, though let's be honest, oil and gas are part of our energy mix for still a long time to come. But what we want to do is help to transition that sector more towards renewable energy. But there are so many skills and capability we have in that sector. And what we need to make sure is that we're not retrenching so quickly that we're losing some of those skills. We need those to help really drive our capability in renewable energy. So I think if we're lucky, a lot of these transitions play out over enough time where we can help to create some of those transitions. But fundamentally, we need to be equipping people with skills that are transferable. So it does come back to education, but also how we live, how we train throughout our working lives, and having the horizontals that drive economic growth working in a country. So it is easy to transition between one location and one company and one sector and another, which is why Paul Johnson gets so wound up about things like stamp duty.
And has done for so long. All right, we have one final question. I can see our next speaker who's joining us remotely, I can see him nervously looking at his watch, and I don't know if he can hear, but I'm promising him that this is our final question. But we started the session a bit late.
Hi, Rolando Morgan here. So thinking back in terms of like in the past, if you think about economic literature, that's kind of compare Britain to maybe Germany in the past, where, especially in terms of finance and industry, maybe Germany's been better in terms of being less short-term in its view. Over recent decades, China's obviously grown massively with a more kind of protectionist approach. Do you have kind of a view of like another nation or region that is doing it right that you kind of look to?
Yeah, it's a really good question. I guess I think for the UK, there's probably things we can learn from many of those strategies. So I think where has Germany been strong? People often talk around one, really understanding apprenticeships in a deeper way. So people being able to develop skills and trade that, but again, that needs to be transferable. And I think the mid-size businesses and also almost how financing works. But then, you know, one of the challenges in Germany is feeling this at the moment is then the world changes and the capability changes, and suddenly maybe we need to be thinking more about creative industries and higher education and financial services. But, you know, maybe those are some of the skills that we'll need more in the future, where the UK's really has strong capability. So I think one of the things the UK needs to be proud of is we are a services-led economy, and that means we're all about people and talent and access to innovation. And so we need to really grow that capability and be aware of what we are really good at. And our universities are our superpower. We have amazing universities that do amazing research, and we need to nurture that capability and the soft power as well that gives us. And then also be clear that, you know, when it comes to the US, and obviously previously now that the world has changed, but I'm sure even I were obviously associated with the previous administration, but I think a lot of that some of that will obviously continue under Trump. But we can't spend at that kind of level in the energy transition. But if we're smart, we can get the regulation and the enablers of that transition happening much better in the UK.
Rain, thank you so much. What was your top fact? What was it? £1 invested by a small company? How much?
£500 by a large company. Just saying.
So says the chief executive of an organisation of large companies.
It is it's from the annual business survey by the ONS.
Okay. Rain, thank you very much.
Thank you.
Okay, so we've had monetary, we've had industrial